reduction in CPI. Prices are going to keep on rising as a result of all that spending. Now, while I'm on the topic of government spending, the debt ceiling again is in the news. And I was reading some quotes online from Janet Yellen, Secretary of the Treasury, talking about this. And you would think, right, if she's the Secretary of the Treasury, her job in theory should be to reassure all the bondholders that America is good for its debts, right? We're going to pay our debts. So don't worry, we will do what it takes to pay you, right? I'm the Secretary of the Treasury, and I'm going to make sure that we prioritize our bondholders. They're going to take priority because, that's the full faith and credit of the United States, right? We can't default on that. That would be horrific. So don't worry, about the debt ceiling. We will pay you. We will find a way. We will cut other spending. We'll do something, but we're going to pay. No, that's not what Janet Yellen is saying, right? Here's one quote from Janet Yellen. Quote, all I want to say is that it's Congress's job to do this, meaning raise the debt ceiling. If they fail to do it, we will have an economic and financial catastrophe that will be of our own making. And there is no action that President Biden, the U.S. Treasury, can take to prevent this catastrophe. And the catastrophe she is talking about is default on the debt, where the U.S. misses a debt payment. Now, if this is so catastrophic, why don't we just avoid it? Again, I've talked about how much tax revenue we have that's well in excess of the interest payments on the debt. Interest payments are something like what, $300-400 billion a year. We're collecting 10 times that in taxes, what, $4 trillion. So we got plenty of tax revenue to pay our debts. But we're not saying we're going to use that tax revenue to pay our debts. No. If we can't borrow more money to pay our debts, then we're not going to pay anything. Again, an admission of a Ponzi scheme. But this is the last thing that you should be saying. I mean, we got people worried about the dollar, worried about the weaponization of the dollar. And we're telling our creditors, you're the low man on the totem pole. It's not really that there's the full faith and credit, because if you own a treasury, the only way you're going to get paid is if we pay everybody else and there's still money left over. Otherwise, you're SOL, right? If we can't go deeper into debt, nobody is saying, right? I haven't heard Janet Yellen or anybody say, you know what, if the Republicans don't raise the debt ceiling, we can't send out the Social Security checks. No, it's all about the debt. The only people who are going to get screwed are the people who own U.S. treasuries. Does that make any sense? Is that what the Secretary of the Treasury should be out there saying? Now, one of the things they're trying to say is that, well, we're going to use the 14th Amendment or something like that to get around the debt ceiling, because they're saying that, that amendment says that that U.S. debt shall not be questioned. But that's irrelevant to whether or not we have the money to pay. It's not about questioning the legitimacy of the debt. I mean, no one's doing that. Yes, the debt is legitimate. We just don't have any money to pay it, right? So to say that, we have to pay the debt and therefore we can raise the debt ceiling. No, if they want to prioritize the debt, they can do it. In fact, what Congress should be doing right now, and what Biden should be leading the charge. Hey, where's the contingency plan? If we don't raise the debt ceiling, what government programs are we going to cut, right? So that we can pay interest on the national debt. What are we going to do, right? Because we have to do something. You can't just not raise the debt ceiling and not have a plan. So let's have a plan B. Okay, either we raise the debt ceiling, or here's all the government spending that we cut, right? And if we're going to default on the debt, well, let's lay it out. What's the haircut going to be? Who's going to, how much are we going to not pay? But then that is not something that we did to ourselves. We would have chosen to do that. If there is an interest payment that is missed on the national debt, it's because the government chose not to make the payment. They chose to prioritize something else, because somebody's going to get paid. It's not like no government checks are going to go out if they don't raise the debt ceiling. Checks are going to go out. They just have to figure out who gets paid. Like any business, you got to prioritize. Or if there's a company, that goes into bankruptcy and there's a trustee or whatever, and he's looking over, figuring out who gets the money, right? Well, if the government can't borrow anymore, right, it's technically kind of broke. So it's got to figure out who gets paid. But right now, they're saying that it's the bondholders who take the first hit, which means, U.S. Treasuries are junk bonds. If that's your, your collateral that you're last. See, normally bondholders are going to be higher up in a hierarchy of who gets paid, right? But now, no, they're low man on our totem pole. So why should anybody want to hold treasuries? I mean, you run the risk of inflation wiping out the value of the treasury. You run the risk of default. You run the risk of, having the U.S. weaponize the fact that you own treasuries against you and seize them for you. We've created so many reasons for holders of U.S. treasuries to want to get rid of them and, of course, get rid of the U.S. dollar. There's one more thing, too, that I want to mention that they're banning about the debt ceiling, and that's this $1 trillion, coin, this platinum coin they want to make, $1 trillion coin, and say, hey, we don't need to worry about borrowing money. We'll just mint $1 trillion coin and give it to the Fed, and the Fed will give the U.S. government $1 trillion to spend. And if we ever did something like that, it would really expose the banana republic that we're living in, because that would really be the government literally just printing the money, because the Fed would have no real asset on its books. I mean, right now, the Fed's balance sheet consists of U.S. Treasuries on the one hand, and then it issues currency, Federal Reserve notes. So the Federal Reserve notes are backed by a U.S. Treasury. But if the Fed will accept an ounce of platinum as collateral for $1 trillion, its balance sheet has a massive hole in it. What does it have on its balance sheet to stand behind $1 trillion? It doesn't have $1 trillion in U.S. Treasuries. It's got an ounce of platinum. What's that worth? Not even $2,000. How could the Federal Reserve, if it ever had to shrink its balance sheet, what asset would it have to buy back those treasuries? A 1 ounce platinum coin? Who's going to take that? Who's going to say, yeah, I'll sell you my $1 trillion worth of treasuries and I'll take an ounce of platinum in exchange? Who the hell's going to want that? Nobody. If the Federal Reserve ever did that, it would be impossible to shrink the balance sheet, because at least when they have U.S. Treasuries, somebody will take the treasuries because they pay interest, right? But who's going to take an ounce of platinum that pays no interest? And what are you going to do with it? You can't do. I mean, you got one coin that's worth $1 trillion. It's not like you could spend it. Where would you want to store that? It's basically what it would be like. It would be like a U.S. Treasury in perpetuity that paid zero, right? Because there's no interest on it, but you can't do anything with it but hold it indefinitely and collect no interest. It's really a worthless asset because the Fed can never do anything with it. So it would mean a permanent increase in the money supply. So it's permanent inflation, and the Fed has no ability to ever withdraw that liquidity unless the government decides that it wants its coin back. But why should it ever want it back? If it can just, mint $1 trillion coin and hand it to the Federal Reserve, why would it ever want it back, right? The Federal Reserve would be stuck with it. But this would expose, right, the whole fraud in this system, that it's just money printing. It's never going to stop. We're never going to get our fiscal house in order. Instead of all this talk about the fact that the U.S. lend money to the Japanese government for 10 years at 40 basis points when inflation is 330 basis points. Well, no, idiot. That's the problem. The only one that's dumb enough to buy those bonds is the Bank of Japan. But they know that if they take away the yield curve control, if they stop creating more inflation, then yields are going to spike, and that's going to force the Japanese government into a untenable predicament because they won't be able to make the payments on the debt. And there's going to have to be a massive day of reckoning in Japan. And so to avoid that political decision, the Bank of Japan is continuing to create more inflation, claiming that there's not enough. Now, at some point, the markets are going to stop believing the Bank of Japan. In fact, the Japanese yen fell about 1.25% on this announcement, but we haven't had a complete collapse yet of the Japanese yen. But as the markets start to see through this charade, it is going to put tremendous pressure on the Bank of Japan. But the reality is the United States is in even a worse predicament than is Japan because of our twin deficits. Japan still operates with a trade surplus, and Japan is still a creditor nation. The United States is the world's biggest debtor nation. We owe a fortune to Japan. The Japanese government holds over $1 trillion of U.S. treasuries. So one way the Japanese can try to alleviate their problem is by dumping those treasuries. They can sell those treasuries and then use the proceeds to pay down some of their own debt. We don't have that luxury. You know, we owe everybody. We're not a creditor like Japan, but the Bank of Japan is already trying to spare Japanese politicians from having to make these difficult choices that they would have to make if the Bank of Japan were to allow rates to rise. Well, the Fed is going to be in a similar predicament soon. Yes, the Fed has been able to raise rates. We got interest rates up to 5%, but we really can't move them much higher because we've already seen the adverse consequences in the banking sector. We've already seen the failure of 3 or 4 major banks. Many more banks would have also failed but for the government backstops. But if the Fed continues on this trajectory, the government might not be able to provide this support. And a lot of these banks that have, gotten a reprieve are going to fail. In fact, more negative news in the commercial real estate market. I was reading about more high-profile defaults on commercial real estate. Sterling of, Greenlight, I forget for the name of the company, that they operate all these, hotels, and they, just couldn't make their payments on a couple $100 million loan on a piece of property, with big warnings out there about the commercial real estate sector and all of this debt. I think it's like $500 million of debt coming due in the next year, several billion over the next few years. And there's not going to be any way to finance this because the value of the collateral has already collapsed. And again, I've been warning about that for years and years when so many people on Wall Street were looking forward to rising interest rates because they thought that rising interest rates would help the banks earn more money because they could charge higher rates. I was one of the few people pointing out the damage that higher rates was going to do to their balance sheets, to their assets, to the loans, the long-term loans that they had already committed to, all of the treasuries and mortgage-backed securities that were on their books. And so all of these chickens are coming home to roost right now. And this is putting a lot of pressure on the Fed. In fact, I was reading an article today on rents, and Moody's, has been tracking rents for about 20 years. And they're looking at, what the typical homeowner pays in interest on, or not in interest, in rent as a percentage of his income. And when they first started keeping track about 20 years ago, the average renter spent 23% of his income on rent. And 10 years ago, that was up to 26%. Today, it's now a record 30% of monthly income going to pay the rent. Now, this is also pre-tax income. So obviously, your after-tax income is diminished, but they're just looking at your pre-tax income, which is not really your take-home pay. But of your pre-tax income, people are spending 30% of that on their rent. Now, what does this mean? This means that people have less money left over for other things. Or if they're trying to save up a down payment to buy a home, well, they have less money available to do that if they're spending more on their rent. But that's not your only cost if you're, renting an apartment is the rent, because you also have to pay utilities, and those rates have been going up. So there's other costs that a renter is going to have to pay that relate to renting a place, and all that stuff is going up. And this is evidence of a diminishing standard of living. That is why a lot more people have to take second and third jobs, because more of their income is going to rent. Now, 30% is the average. That means that there are some people who are actually paying a lot more than 30% of their income on rent. And that is a big number. But, I was reading this article too. It was more of an advertisement, really, disguised as an article from a company that's in the mortgage business. And they're trying to persuade people to buy homes because, of course, when you buy a home, you take out a mortgage. Now, I did read, too, that turnover in the housing market is now also at a record low, because there's a huge spread right now between what sellers want for their homes and what buyers can afford to pay. Because the sellers are still looking at prices from a year or two ago, but buyers can't afford those prices because mortgage rates are so much higher than they were a year or two ago. So there's a big disconnect between what sellers think their homes are worth and what buyers can actually afford to pay for those homes. So it's a huge spread. And so right now what's happening is just there's no transactions because the sellers don't want to come down. The buyers can't come up, right? So it's like a deadlock. And so you're seeing minimal turnover in houses. And again, another thing, and I pointed this out, was that a lot of people, one of the reasons they don't want to sell their homes is because they can't buy another one, because they can't port their mortgage. If you've got a 30-year fixed rate mortgage on a home, the only way you can keep that mortgage is to stay in your home. If you sell and try to buy a different home, well, you're going to have to get a brand new mortgage at a much, much higher rate. So that has really frozen a lot of people in their current homes. And that may be a reason too that people may even pay a mortgage if they're underwater, because what they're really trying to preserve is not their home, but their mortgage. That's their great asset, in that they've borrowed all this money on the cheap and they have 25 years or how many years left to pay it back. But I know I got to take one more commercial break. It was a miss over the consensus, but what was more important was the downward revision, not only to the previous month, but to every month of 2023. The official unemployment rate held steady at 3.6%. That was what was expected. But another weak number, and especially shocking given the ADP number that came out earlier in the week, which was so strong, almost 500,000 private sector jobs. The official number for private sector jobs by the government was just 149,000 jobs. That was well below the 199,000 jobs that had been expected. In fact, the consensus range for the private sector was between 180,000 and 253,000. And we came in well below the low end of that range at 149,000. So a very weak number. Manufacturing jobs, 7,000, a small number, actually a bit more than was expected. It was 5,000, although they did revise down the previous month from 2,000 to 3,000. Now, again, obviously, too, these numbers are guesses because they're not exact, right? It's not 5,000, 2,000, 3,000. I mean, the numbers are coming out exact because they're a guess, right? If they knew how many jobs, they wouldn't end in all these zeros. So it's an estimate. I just think the estimates are probably way off. Labor force participation, that stayed the same at 62.6. This is still a low number. I mean, we haven't really recovered much from the COVID lows as far as
labor force participation. Average hourly earnings were up 0.4. That was a bit hotter than what was expected. It was expected to be up 0.3, and they revised the prior month from up 0.3 to up 0.4. So that's a little hotter on the inflation front, and that's why the year-over-year increase in average hourly earnings came in at 4.4. That was above the 4.2% expected and equal to the 4.4 from the prior month, which was an upward revision from 4.3. So not only was the jobs number weaker than expected, but these earnings numbers were higher. And that is a negative for the market. And the market reaction, again, I think was very telling. Because when the ADP number came out, right, the bond market got killed because the number was stronger than expected. But then when we got the government number coming out weaker than expected, bonds went down again. I mean, they didn't go down as much, but they went down. They didn't recover. You would have expected the bond market to rally. It would have been a relief rally because maybe the bond market thought that given how hot the ADP number was, that the government number would be hot too. Instead, it came out cold, but bonds didn't recover. And to me, that was very negative for the markets because I've been looking for and waiting for a breakdown in the bond market. I've been thinking that we're just going sideways, but that we have another big move down in bonds, meaning a big move up in yields. And that could be happening where we start to see the movement on the 10 to the 30 from a 4 handle to a 5 handle. Remember, we've already got the shorter maturities in the 5s. The longer term bonds should be up there too. And if that happens, if we start moving towards 5% on the 10-year through the 30-year, that is going to be a huge problem because that's going to put a lot more downward pressure on the portfolios of banks, right? All their underwater mortgage-backed securities and treasury portfolios are about to get hammered, which means a lot more bonds are going to be swapped with the Fed because the Fed is there to backstop the banks. This is going to put a lot of pressure on the banks. It's going to put a lot of pressure on commercial real estate, and it's going to put pressure on the stock market. But also what I thought was significant about the sell-off in the bond market that we had on the week is that we didn't get a rise in the dollar. In fact, we got a fall in the dollar. The dollar index closed last week at 102.9, and it closed this week at 102.27. It got clobbered on Friday after we got that weak jobs report. In fact, all of the losses for the dollar happened on Friday with that weak report. But the bond market didn't recover any of its losses. In fact, it closed pretty much on the low of the week. And the same thing with the stock market. The Dow ended up dropping almost 200 points on Friday. So it didn't recover anything. In fact, on the week, I wrote down the numbers. The Dow was down almost 2%. It was the worst weekly performance since March of this year. NASDAQ down almost 1%, 0.9. S&P down 1.16%. So we may have seen the peak in the stock market, especially if we're about to have another leg down in the bond market and a move up in gold. But also problematic for the markets. Look at oil prices. Oil closed at almost $74 a barrel, up $2.06 on Friday. Closed very strong on the week. You know, OPEC had a meeting during the week. I didn't really get any of the news. You know, the OPEC meeting happened about 2 blocks away from my hotel when I was in Vienna. In fact, all the OPEC guys stayed in the same hotel as me because when I came down that morning to leave, because we left from Vienna to Budapest, but as I left the hotel, the lobby was swarmed with OPEC guys. And they had all these cars and police out front and security guards, you know, to protect these guys. But I'm not really sure, again, what happened at the meeting, but oil prices were very firm following that meeting. And so oil is really breaking out. If you kind of look at it on a chart, we're breaking out of this consolidation. Normally, you do see an inverse relationship between oil and bonds because rising oil prices could reflect inflation, and higher inflation is bad for bonds because it erodes away their value. So you've got this move up in oil. Gold, again, I said was up about $6 on the week, but all of that rise happened on Friday. We had about a $14 move up in the price of gold. So gold moved up on the week jobs numbers. The dollar moved down on the weak jobs numbers. That's what you expect. But bonds sold off. And so stocks sold off, and you got this oil rally. So to me, this is negative for the U.S. markets and indicates positive momentum, I think, for gold stocks. I mean, gold stocks were down on the week. They were all up. They had nice gains on Friday. I mean, gold stocks are among the only gainers in oil stocks. But the GDX and GDXJ were still down.
When I started talking about this was because the media is looking at what's going on, and they're surprised by these events as if they just kind of happened out of left field and nobody could have predicted them. And remember, that's exactly what they were saying at the financial crisis in 2008, that nobody could have predicted it. It was a 100-year flood, a black swan, right? It was like, just happened. No, it didn't, because I was predicting it publicly for years. It was obvious to me what was going to happen as a result of these artificially low interest rates that inflated the housing bubble. I saw it. I knew people were taking on more debt than they can repay because rates were so low, and banks were extending credit in that environment to people who were not going to be able to repay their mortgages. I even remember being critical of the fact that when people were taking out adjustable rate mortgages, you could get a Fannie Mae or Freddie Mac guaranteed mortgage just based on your ability to afford the teaser rate. So the U.S. government was guaranteeing that a mortgage would be repaid, but only looking at somebody's income relative to the initial teaser rate on their mortgage. So let's say somebody was earning $2,000 a month and they had a mortgage, and the mortgage was, let's say, $1,000 a month, mortgage payment, and the government would guarantee it, say, okay, we're going to guarantee this mortgage, right? The guy's earning $2,000 a month and his mortgage is $1,000 a month, half his income, but we're going to guarantee it. Well, what they didn't look at was, well, what could possibly happen to those payments in the event that interest rates go up? Well, let's say the maximum payment on that mortgage could have gone up to $2,000 a month from $1,000 a month. Well, is the guy going to pay his mortgage if it consumes 100% of his income? Of course not, because he's got to eat. He's got other expenses. Yet the U.S. government was dumb enough to put taxpayer guarantees behind these mortgages. I mean, so everything was obvious to me in the lead up to the 2008 financial crisis. And then, as soon as the government announced their cure, I knew that the new disease would be even worse than the one they were trying to cure. Although it wasn't a new disease, it was just the same disease, right? We just, made it worse. We just, supercharged that disease so it would come back and do even more damage than the original disease. And that is what is going on. But these commentators are acting as if, we couldn't have saw this coming. I mean, especially when they're talking about what's happening in Europe. I mean, Europe had negative interest rates. How dumb was that? And banks were buying bonds with negative interest rates. I was pointing out at the time the absurdity, how much money was going to be lost by the bag holders, right? Yeah, those bonds were fine as long as you weren't caught holding it to maturity. But, all these banks were dumb enough to put this paper on their books and then say, we're holding it to maturity. It was like, a hot potato. You could get the bond, but you had to quickly turn around and pass it to someone else. Maybe kind of like Old Maid, right? You can win the game of Old Maid, with having the Old Maid in your hand. You just can't have it in your hand at the end of the game. Well, the problem is all these banks, they got the Old Maid, right? The game ended, the Fed jacked up rates, and everybody loses. Every card in their hand is Old Maid. Well, I don't know if you can play that game anymore. It might not be politically correct, so maybe some of you younger guys don't even know what I'm talking about. But the point is, the music stopped playing, and they don't have a chair. Maybe musical chairs, maybe you know that one. But this was obvious. In fact, I was so worried about this years ago, when we were still running Euro Pacific Bank, before it was, put into receivership. And it's almost now, it's going to be 9 months since it was put into receivership. And again, I see on the internet, people, want to blame me. Hey, Peter, why aren't your customers getting their money back? It's not my fault. The money's there. It's the governments that aren't letting the money be returned. That's your government in action, right? They bail out some banks that are insolvent, and then they take a completely solvent bank, shut it down, and they refuse to let the bank return the money to the customers. But I think it will hopefully happen soon. Fingers crossed on that. But years ago, when deposit rates were negative on euros, right, and we had a bunch of euros, and we were getting charged to keep the euros in it, and then we had to pass that on to our customers. We started charging the negative interest rates to our customers because we were paying the bank where we kept the euros negative rate. Now, we could have moved our euros to Deutsche Bank. Deutsche Bank actually didn't have a negative rate. They were like the only bank that we could find that wasn't going to charge a negative rate. But we didn't want to put our euros at Deutsche Bank. Why? Well, because we were worried about the solvency. Even back then, I was worried about Deutsche Bank. The reason that Deutsche Bank had to pay higher interest, than other banks, the reason that Deutsche Bank had to pay a higher interest rate than other banks was because it was riskier. So anybody who put their money with Deutsche Bank in order to get a higher return or to avoid a negative return, which is the same thing, they were taking additional risk. Now, I didn't want to do that, right? I wanted to keep the money safe. I wanted to put it in a bank that was more reliable, more trustworthy. Because remember, my bank didn't have any deposit insurance. So we had to be frugal. We had to actually look around and make sure that the banks that we were putting money with. And at one point, we had a lot of accounts. We had accounts with like 6 or 7 major banks around the world. Now, after the 60 Minutes defamation came out, a lot of these banks that we were working with stopped working with us. So we had to move money around. Our choices became limited after that happened. And, all these banks, it wasn't easy to get accounts with these banks. I mean, they did major compliance on my bank because most banks, they couldn't get these accounts. But we had such good, protocols for KYC and AML. I mean, they wanted to do business with us. We had a very good track record until it was destroyed by the false allegations at 60 Minutes. But again, I don't want to get into that again. But the point I'm making is, way back then, there was risk in Deutsche Bank, and it was apparent. So how are people now so surprised? Oh, they've got a problem in the European banking? They've raised interest rates. They've barely started to raise rates. What is it, 3% in the Eurozone? It's 4% in the UK. They got 10% inflation. They're not even close to rates high enough to fight that inflation. Imagine what would be going on in Europe right now if they did raise rates high enough to fight inflation. I mean, could you imagine if everything is collapsing now and the rates are still this? Home sales continue to fall. And in fact, at this point, year over year, the decline in home sales is now an all-time record. We've never seen year-over-year sales fall this much, including the crash in 2007, 2008, when the housing bubble popped. It's already worse than that. But what we haven't seen yet is the collapse in home prices. That's coming, and we haven't seen the surge in inventories of unsold homes. That's coming too. In fact, a lot of people, I believe, are going to put their houses on the market once they see what's happening to the market. They're going to want to get out while they can.
Peter Schiff, the renowned American investor and economist, has been warning for years about the potential for a coming economic crisis, and now it seems his predictions are becoming a reality. In a recent podcast released on his YouTube channel, Schiff declared that a collapse in home prices and a surge in inventories of unsold homes is imminent, as most people will lose their homes and jobs. His stark assessment of the current economic situation has caused alarm amongst the public, as many fear what the future may bring. Schiff's dire predictions have been met with both criticism and praise, as some believe his warnings are exaggerated, while others believe they are accurate and timely. For those skeptical of Schiff's predictions, it is worth noting that he accurately predicted the 2008 financial crisis and has warned of another one for years. Regardless of whether or not his predictions are correct, it is clear that the economic outlook is uncertain and that people should be prepared for the possibility of a downturn. Welcome back to our channel. In this video, Peter Schiff talks about a collapse looming in the housing market and the possibility of people losing their homes and jobs. Please watch, like, and share this video. Also, drop your comments and thoughts below, and remember to subscribe to the channel for more related content similar to this. We begin with a short clip of Peter Schiff.
And I'm convinced that Q4 is going to be another negative quarter. So the first 2 quarters of the year were negative. We have the one lone positive quarter in Q3. I think not only will Q4 return to a negative quarter, but I think it could be the biggest negative quarter of the year. So ending the year on a low note, even though we may end on a high note in the financial markets, we'll end on a low note in the real economy. And of course, that will be the reason for the rally, because it will add to the expectation of the Powell pivot and the false belief that the inflation fight has been won. The reality is the inflation fight has been lost. And that's because investors still incorrectly believe that a weakening economy will also weaken inflation. It won't. It will strengthen inflation. Stagflation is going to get worse. It's going to be a combination of recession and high inflation. And the markets are not prepared for that. The Fed is not prepared for that. Nobody, other than me perhaps, is prepared for that, and people who have been following my investment advice. But getting back to these numbers, we got the advanced look at trade deficit in merchandise for the month of October. Now, remember, I said that the reason that we had growth in Q3 was because the trade deficit came down. Well, in October, the trade deficit shot back up, and that is the first month of the fourth quarter. The expectation was for the deficit to actually fall from a slightly downwardly revised $91.9 billion in September to $90.8 billion in October. Instead, the deficit soared in the other direction, all the way up to $99 billion, not only blowing away the estimate by 10%, but far exceeding the upper end of the range of estimates, which went from a low of $88.3 billion to a high of $94 billion. So this $99 billion deficit is huge. And in fact, it's even worse when you look at the internals, because imports were up 0.9, but exports collapsed 2.6%. So our economy is exporting less, but our consumers are importing more because we keep on spending money to buy stuff that we didn't make.
Schiff said he predicted Q4 of the year to be another negative quarter, and he was right with his prediction. We saw the trade deficit, which came down in Q3, coming back up in the first month of Q4. The world's financial markets have been in disarray, with stocks plummeting and currencies losing value. Businesses are closing their doors, and people are struggling to make ends meet. It is a true crisis that is showing no signs of subsiding, and it has become impossible to ignore the dire situation we find ourselves in. Despite the immense hardship, however, there is still hope. With resilience and determination, individuals, families, and communities can still rise above the adversity and rebuild a better future. Listen to these carefully.
If the Fed is going to succeed in bringing down inflation, we have to stop doing that. We have to stop spending, but we're not. We're spending more as evidenced by the trade deficit, but we're producing less because we're exporting less and importing more. This is bad news for the economy, but it's also going to directly subtract from Q4 GDP. And in fact, look at retail inventories, an advanced look on October inventories, and they fell by 0.2. And the prior month, which was in the third quarter, was originally reported as up 0.4. It actually was revised to minus 0.1. So inventories falling is also going to directly subtract from GDP. But why are inventories starting to fall? Because businesses are starting to wise up and they're realizing that their customers are broke and they can't afford to buy. So as they're selling down the inventory they have, they're not restocking it because they know the customers are just not there. In fact, there were some negative comments today coming out of Amazon that supports exactly what I'm saying. But the market just shrugged it off because they were looking at the potential of the Fed throwing in the towel on the inflation fight, given all the weak economic data that was coming out and that investors rightly perceive will cause the Fed to change course. They're wrong in what it's going to do to inflation, but they're right about what's going to happen to the economy and the fact that Powell is going to care more about a collapsing economy than he will high inflation, despite his current rhetoric to the contrary, because he's only talking tough because he thinks the economy can withstand it. But once he realizes that it can't, he's going to be singing a different tune.
Schiff believes that if the Fed wants to succeed in bringing down inflation, there is a need to stop exportation and high spending and encourage more importation. He argues that if the Fed can manage this effectively, it will help stabilize the economy and bring down inflationary pressures. The economy has been slowly crumbling around us for years, and now a great collapse is imminent. Millions of people will lose their jobs and homes, and the shockwaves will be felt across the country. The consequences of this collapse are far-reaching, and it's a devastating blow to the financial security of many. Economic uncertainty is the game's name now, affecting everyone, from the average citizen to large businesses. Banks are tightening their lending practices, businesses are downsizing, and people have to make difficult decisions about their financial futures. The collapse would surely create a ripple effect that will be felt for years to come. Listen to these carefully.
We also got more weak data on the housing market. What would you expect? We got pending home sales that fell a little bit less than expected. They were down 4.6%. The problem is there's going to be a glut of sellers and a lack of qualified buyers because mortgage rates are close to 7%. That is the problem. People can't afford to pay these prices with these interest rates. When interest rates were 3.5%, people could afford it. I mean, they couldn't afford it, but they could qualify for the mortgage, and based on the low payments, they could swing it. But they can't swing it anymore because they can't get those low payments because those low rates no longer exist. And so the market has to reprice for higher interest rates, and the implications are severe because this is going to be a dramatic decline in home prices. Now, a lot of people are going to initially assume that that means inflation is coming down because real estate prices are going down. No, doesn't mean that at all. Just like stock prices going down doesn't mean inflation is coming down. It just means inflation is moving from financial assets like stocks or real estate to consumer goods. And again, as I've been reiterating on this podcast, housing prices coming down doesn't mean the cost of shelter is going down. It's not. It's going up because what counts is not how much you pay for the house, but what your monthly mortgage payments are after you buy the house. And even if the price of the house is down, if the mortgage interest is higher, the monthly payments on a lower priced home could still be higher due to the increased interest rates. But the mortgage is not the only portion of the shelter. There's insurance, there's maintenance, there's utilities, there's taxes. All of that adds to the cost of home ownership. And all of those prices are going to be going up. So investors will initially be fooled into thinking that falling real estate prices will provide some kind of relief in the CPI, but it won't, because shelter costs are going to go up even as real estate prices are coming down. And so that's a 1-2 punch to the average homeowner, because the value of his asset, his home, is going down, but the cost of living in that home and the cost of everything else is going up. So as the cost of living rises, your net worth is falling, you're poorer, so you have the reverse wealth effect.
According to Schiff, the fluctuation in stocks cannot be compared to inflation. He believes that if stock prices go down, it does not necessarily mean that inflation will go down as well. This is also similar to housing prices and the cost of shelter. The world is currently standing on the edge of a great collapse. This is a time of great uncertainty, as the future of the global economy hangs in the balance. As the pandemic continues to surge, more and more people are being affected. Many are facing job losses, and a great number of people are at risk of losing their homes. This is a time of great fear and distress, but it is also a time for hope and resilience. There is still time to take action and weather the storm, but it will take determination and courage to get through this difficult period. Listen to these carefully.
Most Americans, their largest asset is their home equity, and their home equity is going to be vanishing at the same time their cost of living is going to be surging. This makes everything so much worse, because at least in the past, as consumer prices were rising, but wealth was also rising because of increased real estate prices and more home equity, that took some of the sting out of rising consumer prices, because at least you were wealthier. But when your home equity is evaporating because real estate prices are plunging, but the cost of living continues to go up, that compounds the misery, because consumers no longer have the increased wealth to help offset the effect of higher prices. They're getting poorer as prices are going up. That really stings.
Schiff has been preparing the public for the inevitable economic disaster that will leave most people homeless and unemployed. Some of the things he has warned about include getting out of debt, learning how to invest, and having an emergency fund ready to survive the coming storm. He believes that the current economic system is unsustainable, and only those who are prepared and have always followed his advice will make it through the crisis unscathed. With the number of people affected by the pandemic rising and the stock market in a state of flux, it is more important than ever to take Peter Schiff's advice and prepare for the worst. The great collapse is here, and only those who heed Peter Schiff's warnings will be able to survive it. His message is an important reminder to be prepared and to take steps to protect yourself and your family during these turbulent times. That's all for today. Kindly share this video with your family and friends, and don't forget to hit the like button and subscribe to our channel for more updates like this. Thanks for watching. Anticipate our next video update.
Right? And that's why so many lawyers go into politics, because they have a lot of practice lying, and if they're really good at lying, then they're going to politics. Now some lawyers who are really good liars, after they go into politics, then they become judges, right? Because they're lawyers with political connections, and so everybody is lying. So the fact that Biden lied, I mean, it doesn't shock me, and the fact that he took bribes. I mean, a lot of people, that's why they go into government, so they could sell their influence, so they can take bribes. Now, a lot of times they wait until they leave, right? They go to Washington, they make a bunch of friends, and then they leave, and then they become lobbyists, and they sell their influence that way. Now, that at least, I guess, is legal. What Biden did, he didn't wait until he was out of office. He did all of it while he was still in office, while he was still the acting vice president. That's what makes this really criminal. But I think what's worse is the way the media is reporting this or not reporting it. Go out there and look at all the mainstream media reports. about this. And they all start off with Republicans have no proof that Biden did anything wrong. This is all a witch hunt because at the end of the day, the Republicans can't prove that Joe Biden was in any way connected to all this money, which is BS because they don't have to prove it. It's a circumstantial case. The government doesn't have to find a document where Biden signs a contract where I will do this for you in exchange for this money. You're not going to put a bribe in writing. That's the whole point. Yes, obviously there was a backroom deal, right? A quid pro quo in verbally, right? Couple of people meet and they agree to do something. They don't leave a paper trail. The trail is the money. That's the evidence. The fact that you have 16 companies with no business purpose, performing no services that you know of, selling no products, earning all kinds of money without any invoices, and then you have all of these transactions without any legitimate purpose, and then all the money finds its way into the pockets of Biden family members. Like, is this some kind of coincidence that all this is happening? All of these foreign interests are just lavishing the Bidens with money just, for nothing? Of course, it's obvious what's going on here. Once you show this, this is how governments do money laundering investigations. I mean, I don't know. I mean, 7 governments have investigated my bank for money laundering, and they found no evidence of it. Well, there's plenty of evidence that the Bidens were laundering money. I mean, it's all there. I mean, this is exactly what they look for. Structuring, shell companies, transactions without any legitimate business purpose. That's what was going on. Now, the burden now, once you have this case, this strong case, circumstantial case against the Bidens, it would be up to Joe Biden and his family to now show the legitimate transactions that were taking place. Where are the invoices? You got all this money for doing what? Prove that you did something of value to earn this money. They should have the documentations of what they did. I mean, because if I'm going to send somebody millions of dollars, they better send me an invoice. I want to know what I'm paying for, right? I mean, what work did you do? I want to make sure you're not overcharging me. Produce those invoices, produce those documents. They can't do anything. They've got no evidence. So the media is focusing on the fact that there is no smoking gun that says, here's a contract that we have between Joe Biden and the Chinese, where Joe Biden is going to, pass this legislation or enact this in exchange for this money. There's no way that document is going to exist. That never exists. I know the government probably puts people away for money laundering, for RICO violations, with a lot less evidence than they got against Biden, because they don't have to have that smoking gun. When you can build a credible, strong, circumstantial case, if the person you're accusing can't come up with a rational explanation for what looks obvious, then he's going to be guilty. Yet the media doesn't even want to acknowledge that the president might be guilty. Instead, they're attacking the Republicans. I mean, imagine if this was Trump. Imagine if this happened with the Trump family and all this money was going to his kids. I mean, they would be all over him. They already are all over Trump for doing nothing. What did Trump do? He paid some money to somebody not to talk about something, a non-disclosure agreement, perfectly legal. They're just thinking, well, did it violate campaign finance laws? That's nothing compared to what Biden was doing. In fact, what Biden was doing is much more than the Watergate. I mean, Watergate was nothing compared to what Joe Biden obviously did. Yet the media doesn't care. Meanwhile, everybody is talking about how this jury said that President Trump back in the 1990s, I guess, sexually assaulted, did not rape, but was too sexually aggressive with this woman in Bergdorf Goodman's back in the 1990s. I mean, who the hell knows whether or not this happened. I mean, maybe Trump forgot about it, or maybe it did happen, but, who cares? That was in the 1990s. I mean, maybe Donald Trump made a pass at this woman. Maybe he didn't. I don't know. Maybe it went a little far. Who the hell knows? But she didn't say anything about it in the 1990s or the 2000s. She just starts talking about it now. Yet the media wants to make this into a big deal. It was a different world back then than it is now, as far as what men could do. I mean, maybe you got a slap in the face if you were a little bit aggressive, but that was it. I mean, obviously times have changed now, but back then, that's how it was. But that's nothing. The media wants to focus on this, and of course, this lady is getting $5 million for defamation, right? I'm in a defamation lawsuit myself. She's getting $5 million because she accused the president of raping her. The president said that's a lie. And now she gets $5 million for defamation. Well, it was a lie because the jury didn't find any evidence of rape. Now, yes, they did claim that there was evidence of harassment, but that's not the same as rape. And so isn't he entitled? If somebody says, hey, you raped me, can't you say, no, I didn't? That woman's a liar? I mean, now if someone falsely accuses you of rape, you could still be sued for defamation if you call your accuser a liar, even if it turns out that they did lie about the rape, but maybe there's something else that you did that's not nearly as bad as rape, because whatever he's accused of doing is not rape. It's not even close. Rape is really, really bad, right? If you're just getting a little fresh with a woman and she feels uncomfortable, that's not raping her. I mean, that could be wrong, bad behavior, but it ain't rape. Rape is a whole new level. So if somebody says, yeah, he kissed me and I didn't want him to, and he raped me, and then you say, I didn't rape her, and it turns out that you did kiss her, but you didn't rape her, and she accused you of rape, and you said that she was a liar, you were right to call her a liar. It was perfectly legitimate to do that, but now apparently it's not because he was awarded defamation. But the media is making a mountain out of this molehill. Here, Joe Biden has an actual mountain. This is a Mount Everest of evidence against Joe Biden. And the media is making a molehill out of that mountain by attacking the Republicans for going after the Bidens. When what the Bidens did was wrong, the media should be outraged by this conduct, especially so overt as to what actually took place. And the guy is still in office. And so that, to me, is more outrageous. I mean, the media, right, is not reporting the news. It is all fake news. The media is covering up, right, the Biden crimes. Now, why are they doing that? Well, obviously, because they don't want to hurt Biden politically, because they don't want to help Trump, because Trump's the most likely person that Biden is going to run against. And the last thing the media wants is a second term for Trump. And so if they have to lie and cover up all this dirt on Joe Biden in order to help ensure that Donald Trump doesn't have another term, well, that's what they're going to do. But that is not what the press is supposed to be here for. The press is supposed to, help protect us from corrupt government by reporting on the corruption, by keeping some checks and balances on government. I mean, that's the whole role of a free press, to help protect us from an oppressive government, not to help protect an oppressive government from the people, help an oppressive government cover up their crimes. But that is exactly what the American media is doing. And I think this is really a new low in the way they are covering this. And I'm sure more stuff is going to come out on this investigation as it continues. But one other thing, too, that I wanted to talk about related to media bias, because I read this long article in The Atlantic, and I wasn't really familiar with this story until I read this article. And it's about this guy, Jeff Karpoff, who started this company, DC Solar. And the guy is in jail now. He was sentenced last year. He's got a 30-year federal prison sentence for fraud, or I'm not sure exactly what he was convicted of, but he did a lot of bad stuff, and he's got 30 years in prison. But the article goes over this gigantic Ponzi scheme that he was running with DC Solar. But the article completely misses the point that it's the government that is responsible for all this. And it is just more proof that we don't want government involved in the economy. We don't want government picking winners and losers when it comes to business because it just picks losers. You see, what this guy did is he invented a portable solar generator so that if you run out of power, you can just truck this generator in and it runs on solar power. And of course, the government loved this. President Biden made this guy's company a partner of the U.S. government, along with companies like, Alphabet and Amazon. He created some kind of group of companies that were partners in the battle against climate change. And so this company was exactly what the Democrats wanted because it was solar power. It was green energy. This was great. So they had the government's good housekeeping seal of approval. But what else they had from the government was a tax credit. Back in 2005, the government passed this accelerated tax credit for solar. And whatever you spent on some solar product, you could get a tax credit for 30% of the purchase price. So if you bought something
want to buy something from a vending machine. That's the problem. Hi, Peter. I live in Brazil. I own gold and silver. I'm patiently waiting to invest in a Brazil fund, such as small caps. Yeah, Brazil stocks have been killed. We own one Brazil stock right now in our portfolios. We used to own 3. We got rid of 2 of them a while ago, years ago, but we still have 1. In retrospect, we should have sold that one too, because we could buy it back cheaper now. But no, I think there's some opportunities. I mean, Brazil is not my favorite country. They have, it's certainly not even close in South America, but there's some good value down there. I mean, see, the difference is the U.S. stocks have gone down a lot, but they're still expensive, and they're going to get a lot more expensive after these bailouts and stimulus and all this draconian socialist legislation that's coming. But, I think there's a lot of bargains in the emerging markets. I think there's some really good cheap assets there with good dividends. And yeah, we're taking advantage of that. I mean, those are going to be good investments, I think, and they're going to be great inflation hedges when the emerging market currencies really start to soar, and it's the dollar that ends up submerging. Here's a guy from San Juan, Alan R., $20. It looks like the panic margin selling in gold is done. Do you think metals have bottomed? Most likely they have bottomed. Yes, I do. As I said, I didn't expect the correction to get much more than 10% when it started. This is a much more shallow correction. We had a 30% decline during the 2008 financial crisis, like an official bear market, before we went up to 1900. I think this is much more shallow. I think the next stop after we go through 2000 is probably somewhere between 5,000 and 10,000, but that's not going to be the end. See, I used to have a $5,000 target for gold back in 2008. People made fun of me because we only got to 2,000. But I had a $1,000 target when it was under 300, and we hit that. But Peter, you said $5,000 gold. It didn't happen. Yeah, it's going to happen now, except now we're going to be looking down at 5,000 instead of up at it. Because since we've printed and created so much money since I made that call, we're actually going to probably go much higher than 5,000. That call wasn't bullish enough. The difference is it's taking longer than I thought, but now we're going to get even higher than I thought. I wasn't wrong. I was early. It's the people who said it wasn't going to happen. They were wrong. They were wrong early, and they're wrong now, and they've probably always been wrong. An apple is $1 and gold is 1,500. 1 ounce of gold buys 1,500 apples. Money supply doubles. Apples are $2 and gold is 3,000. Gold has capital gains. Yes, exactly. That's the problem. If everything doubles, you don't actually have a capital gain in gold. Your purchasing power hasn't changed. And so if you sell and the government says, oh, you've doubled your money, we want half of that in taxes, you're actually poorer than you start. Now, are you as poor as the guy who didn't have gold and only had money in paper? No, because he lost a lot more than you did. But what if the capital gains tax goes to 90%? Then you're barely better off. Now, the key is, I think if apples double, the gold price might triple. And so the price of apples may actually go down in terms of gold, but not as much as the capital gains is going to hit you. That's why you need to be someplace without a capital gains. Or if you're transacting in physical coins, which is what I'm suggesting that you do at Schiff Gold, buy some physical coins. If you go out and use your physical coins to buy an apple, the guy who sold you the apple and got your coin isn't going to tell anybody that you gave him a silver coin for his apples. And so if you don't tell anybody, nobody will know, right? What do I think about anarcho-capitalism? What do you think a government should do about the coronavirus? Look, I'm not an anarchist. That's anarcho-capitalism is anarchy. I don't believe in anarchy. I believe in limited government. I'm very much on the same page as the founders. I mean, I think anarchy would be great if it could exist, but I think it's like a vacuum. I think when there's no government, some government is created, to fill the void. And so rather than waiting for a bad government to come into existence on its own, let's set one up with a lot of strings. Let's set up a limited government with a constitution now so that we know what we have before something worse just comes into existence. The problem is, you could set up a great government like our founders did, but over time, the government finds a way to unbind itself from those chains. And you lose the freedom. That's why everyone said, well, 200 years maybe will last, because they know what happens. But yeah, so anarchy would be good if it could last, but I just don't think it can, which is why I want to set up a limited government, which is hard to keep. That's the problem with government. Once you set it up, it's hard to keep a limit on its power, right? It's like that camel's nose under the tent. Kindly elaborate on the economic implications for the real crash in Europe. Look, there's a lot of problems in Europe, particularly in, some of the countries, Italy, Spain, Greece, Portugal, coronavirus making it even worse. And now the countries that are normally creditors like Germany, now it needs to borrow. Everybody can't borrow. Somebody has to lend, right? It was okay when Germany and Japan and China were lending, other nations could borrow. But when they're borrowing too, we all can't borrow, right? Somebody's got to be on the other side of that transaction, right? Everybody can't be a buyer. Somebody has to be a seller, right? It takes two to tango. And so we all can't have a one-sided tango. It's just not going to work. So look, there's a day of reckoning coming in Europe and Japan, all over the world. People should own gold everywhere. People should own real assets everywhere. But I just think the day of reckoning will be particularly harsh in America. We have benefited the most from the fiat monetary system, and we will lose the most when it comes crashing down. Our economy is the most screwed up as far as the least percent of our economy being manufacturing, the most percent being services, the largest trade deficits, the largest budget deficits as a percentage of the real goods producing portion of our economy. Our government has guaranteed more debts and more liabilities than anybody else. And so, we're just set up for a bigger fall. We've had a bigger ride on the way up. It's going to be a bigger crash on the way down. That's why I think it's particularly important for Americans, but it's also important for everybody. So no matter where you live in the world, I think you will benefit from implementing my investment strategy long term. But it's not about short-term trading. If you believe that I'm right, that the music's going to stop playing, right, and there's going to be a big day of reckoning, and you want a portfolio that will do the best when that day comes, then that's what I'm doing. I'm buying the companies that I think will hold up the best. You got to have something. You got to, if I'm right and cash is trash, it will be, then what are you going to own instead of the trash? That's what I'm doing. I'm your garbage man to get rid of your trash. Well, people don't know it's trash. And let's get some real stuff. So if you're anywhere in the world, go to our website at europacificfunds.com and contact us. Your thoughts on fractional reserve banking. If we go back to the gold standard, what we have, Pat, look, fractional reserve banking, we had that under the gold standard. Banks loan money out. That's how come they can pay interest. That's the whole idea behind a bank. They're not going to keep all the money just in a vault. They're making loans. So there's always going to be some kind of fractional reserve. But in a free market with gold money, banks compete with one another for safety, and no bank wants a run. And so the way to make sure that you don't have a run is you don't loan out, make too many loans, but you also don't loan out demand deposits. See, there's a big difference between a demand deposit, at least there used to be. There's not anymore. The whole banking system is screwed up thanks to the Fed. But when we had honest money and honest banking, you had demand deposits and you had time deposits. People didn't loan out demand deposits because they were available on demand, and they didn't pay interest because if they're not loaning out your money, how are they going to pay you interest? In fact, they charged you to hold your demand deposit because the bank wasn't making any money if it wasn't using your money. So it charged you for storing it. It charged you for having a checking account. You paid every month. You paid per check. That was a service that people were paying for. People don't pay for that service anymore because the bank takes your demand deposit and loans it out. Well, how are they going to loan it out if it's supposedly they're on demand? That creates a completely unstable banking system. Now, if you had a time deposit, let's say you went to the bank and you said, yeah, I'm going to lock this money up for 5 years. I'm not going to come get it for 5 years. Now the bank is like, whoa, you're tying the money up for 5 years? I got 5 years to make loans. I can loan it to some entrepreneur who needs some new equipment for his business. I can loan it to this farmer, right, who, to get him through to harvest, right? I got time on the money. So now the bank can make a loan and maybe charge the farmer, 8% for the loan. But because he's charging the farmer 8%, he can pay you 3% for your money. And why does he have to pay you? Because there's another bank that can make loans and he wants your deposits. So everybody is competing by offering higher loans, but they can't offer too high an interest because they need a profit margin. And even on a time deposit, You're not going to loan out all your time deposits, because you know what happens? Somebody tells you, here's my money. I don't want it for 5 years. And they buy a CD. And then an emergency comes up and they go to the bank and they say, I need my money back now, right? Now, sometimes there's a small penalty if you break a CD early, but it's not that big a deal. But what no bank wants to do is tell somebody that comes to their bank because they need their CD early and says, I lost my job. I actually need the money now. I can't wait 5 years. Nobody wants to hear their bank say, I'm sorry, but we loaned it out. Come back in 4 years and you can have it. Everybody's going to want their money out of that bank. So people still didn't loan out. They still had their reserves. But it was the free market that dictated how much reserves you would keep in order to maintain your reputation and integrity. Because as a bank, the worst thing that can happen is people don't trust your bank, and now there's a run on your institution. So it's the value of reputation in a free market that keeps banks safe. And without government guarantees, banks, they shop around for safe banks. They don't want to put money in a bank that's reckless, that's making reckless loans, that doesn't have a lot of reserves, because that's their life savings. They don't want to risk losing it. The system we have today is completely nuts. The government corrupted it, right? All the deposits are guaranteed. So the minute the bank gets your money, they do all kinds of stupid things with it. It's all gone. And nobody cares because the government's guaranteed everything, right? And when it all comes crashing down, they blame capitalism. Oh, look at these banks. Look at all these crazy, stupid things they did. Of course, because the government made them do it. The government guaranteed all the loans. The government has deposit insurance. The government is going to bail them out if they fail. It's moral hazard, squared now. So we have the most unsound